Good day, friends. In the last video, we discussed about the income statement. We learned about terms like income, profit, earnings, expenditure. In this video, we're going to be discussing another very important subject, and that is cash. Yes, cash. We're going to be understanding why cash is so important and what the difference between cash and profit is. In our consulting practice, we keep coming across companies who always lament that we seem to have made a profit, but where is the cash? This issue of cash is probably one of the most important aspects of managing organizations. In fact, Dun& Bradstreet in their analysis say that 90% of small businesses fail because of difficulty of managing cash. We're going to be discussing why cash is considered king and not profit. And before that, we need to understand what is the difference between cash and profit and why cash indeed is king. Cash is real, profit is made by accountants. You can't pay salaries with profit, only with cash. You can pay salaries only if you have cash. Cash helps a company tide over business cycles. Cash enables company to take advantage of opportunities. Cash helps demolish competition. In fact, if you look at some of the most successful companies in the world, you'll find that they are rich in cash, and that is what gives them the competitive advantage. And this is the reason why we learn about cash. And just like the balance sheet and the income statement, there is a very important third statement known as the cash flow statement, and this talks about the whole issue of cash flows. Before we get into cash flows, let us try and understand what cash is and how cash is different from profit. In the last video, we learned about the profit term EBIT. Earnings before interest and tax is one kind of profit that is reported in the balance sheet. Now, from this, you have to deduct a few other elements. What are those elements? First, you have to deduct interest. Then you have to deduct taxes paid. Then you have to deduct any money that you would have used to buy assets. Then a lot of this money, this profit or EBIT, is stuck in the form of unsold inventory. And finally, you may have sold the material and recorded the profit, but you may still not have got the money in hand because your customers haven't yet paid you. So after you deduct all these from EBIT, whatever is left is cash. Now, in addition to understanding cash, you also need to understand the concept of cash flow. Cash flows into a company and cash flows out of a company. And what is left between the inflow and the outflow is the cash that is retained, and that stays in the company as cash reserves. So this is the basic concept of a cash flow statement. Let's understand cash flows. How does cash increase in business and how does cash decrease in business? And what is the relationship between profit and cash? First, we must understand that in balance sheets or any financial statement, the system of accounting is known as accrual basis. Accrual basis means as soon as a transaction occurs, whether it's a sale or an expense, it is recorded whether the actual money has left the company or not. For example, if I make an invoice for $100,000, it is immediately recorded in my income statement as $100,000 earned. But I may not have got the $100,000. So till I get the $100,000 in hand, it's not cash in my hand, it's only profit in hand. Similarly, suppose I have made an expenditure of $50,000. This $50,000, as soon as I decide and create the transaction document for the expenditure, it is removed from my profit. But as long as I have not paid the money to the person from whom I'm buying the service, this cash stays with me. Therefore, though the expense has been recorded in my financial statement, the cash has not yet moved out of my company. Therefore, there is a difference between profit and cash, and profit is a book number, but cash is the actual money that you have for doing all of what we said earlier, that is paying salaries, buying material, etc., etc. That is the reason why cash is king. Very often what happens in organizations is an organization has a profit, right, in the books, but the company finds that it is not able to convert this profit into cash, and this is where companies get into trouble. And that's why it's so important to understand cash flow to know where the profit that you seem to have in your books has actually gone. Now, there are several ways in which cash moves in and out of company, and we should understand that, and this is called cash flow. Cash increases or decreases in a business by certain events or activities in the business between two periods. For example, when there is an inventory decrease, right, cash increases. Whenever there's an increase in accounts receivable or money to be obtained from your customer for things that you have sold, cash decreases. Whenever there's an increase in payables, that means what you need to pay for goods that you have purchased, cash increases. That means if inventory goes up, cash comes down. When the amount of money that you need to get from your customers increases, that is receivables increases, your cash comes down. When the amount of money that you need to pay, which is payables, goes up, your cash increases. Therefore, these transactions change the amount of cash that you have in hand. This is the essence of a cash flow statement. As per generally accepted accounting principles or GAAP, cash flow needs to be reported in a company in a certain format. And this format requires that the cash flow statement has three broad sections in which cash has come in or gone out of this company. The first section is known as cash flow from operations. The second is known as cash flow from investing activities. And the third is known as cash flow from financing activities. The most important of these is cash flow from operating activities, because it is this cash flow that tells if your company is really making money or not. Now, what are the factors that contribute to cash flow from operating activities? Number one, of course, is the operating profit or the EBIT. You must have earned money at the earnings level. Now, to this number, you add back certain things. You add back certain adjustments. One, you add back what you may have kept aside as depreciation. In the last video, we discussed that depreciation is an amount of the profit that you keep aside for a future contingency. So you have only kept it aside in the books of accounts, but the cash has not yet been spent. Therefore, there is cash available to you. Any decrease in the inventory between two periods also, as we said, increases cash. Any increases in payables also increases cash. Any decrease in receivables increases cash. You need to subtract certain things. That is, if the inventory has increased, you need to subtract it. Similarly, if payables have decreased, you need to subtract it. And if there are any increase in receivables, that also needs to be subtracted. After you do all this arithmetic, you get a figure called cash flow from operating activities. The second broad category is what is called cash flow from investing activities. What are these? These are any sale, that is inflow, or purchase, outflow, of a company's long-term assets like land and machinery, buildings, investment in subsidiaries, etc. So any cash movement out of the company on account of any long-term purchases is categorized under the broad head of cash flow from investing activities. And finally, there is a broad head called cash flow from financing activities, that is borrowings, inflow, or return of borrowings, which is outflow, or cash which may have come from the owners of the company by way of stocks or equity, which is inflow, and any payment back to the owners or borrowers, which is outflow. So these are the three broad categories under which cash is recorded. Now, let's look at a balance sheet. Here is a balance sheet of a company, and as you can see, this balance sheet shows the balance sheet numbers for 2 years, year 1 and year 2. And the next statement is the income statement. Now, we are familiar with both the balance sheet as well as the income statement. Now, the whole cash flow statement of the company is constructed from the data available from both the balance sheet as well as the P&L or the income statement. As you can see, in this particular balance sheet, between two periods, the debt has increased, or what that means is we have borrowed more. So this is an increase in cash. Similarly, look at the assets part. Your inventories have gone up, which means your cash has come down. Your receivables has gone up, which means your cash has come down. Similarly, you have gone and invested in an investment vehicle. So this has also decreased your cash. So this is the way in which you take information which is in the balance sheet and construct the cash flow statement which is given here. So finally, friends, a cash flow statement is a statement that records how money has come into the company and how money has gone out of the company, and how much of that cash have you retained as cash reserves in the organization. And as we said early in this video, cash is extremely important, and those companies which are rich in cash are the companies that find favor with investors, are the companies which don't have problem in paying salaries and wages, which are having money to take care of contingencies, or are able to survive the ups and downs of the markets. Therefore, gentlemen, cash is indeed king. Thank you.